Welcome back to the next in our series of videos on Introduction to Financial Services. This is part 3 of fixed income products. So let's get right to it. I guess you guys have all seen my disclaimer before, so I'm not going to worry about that. We're going to start talking about governments, U.S. government, Treasury securities. So basically, and I said this earlier, people talk about govies or treasuries or U.S. government, they're all the same. So if you hear somebody talking about govs or govies or U.S. government or U.S. treasuries, all of those terms refer to fixed income products, debt products from the U.S. government, from the U.S. Treasury. They're all bonds or securities issued by the U.S. Treasury for the U.S. government, that basically gives the U.S. government the ability to raise money for the operation of the U.S. government. So a bond or a debt obligation is issued by the government authority with the promise of repaying upon maturity and is backed by the government. That's the U.S. government security. Government securities may be issued by the government itself or by one of the government agencies. These securities are considered low risk since they are backed by the taxing power of the government. So since the government can tax you, they're considered low risk because you know that the governments can be able to pay their unless, of course, as you follow the newspaper, unless the government defaults on payment and does not pay, in which case that would be catastrophic for the government in their ability to borrow securities in the future, to borrow money in the future and issue future securities. But at the same time, because they tend to be low risk, they pay very low interest. We actually saw a year ago, actually a negative yield on some U.S. securities, some government securities, which was very highly irregular. And that would be a separate discussion itself. But it's not uncommon to see the interest on these products be 1%, 2%, less than 1% even, we've seen. But 2, 3, 4%. They're very, so because they're low risk, they pay low interest rate. So what does that mean? Well, that also means that other products that are a little higher risk, corporates, for example, in order for corporations to sell their bonds, they're a little higher risk, but they have to provide a higher reward. They're going to provide a higher interest rate. We always have this equation, risk and reward. Low risk is going to be low reward. Low risk is going to be low interest rates, low dividends, low coupons. High risk, you're going to have higher reward, higher interest rates, higher dividends, higher coupons. So the first type of we're going to talk about is Treasury bills, also known as T-bills. So U.S. Treasury bills or T-bills are one type of U.S. Treasury security. And they're a short-term debt obligation for the U.S. government with a maturity of less than 1 year. So T-bills are sold in denominations of 1,000 up to a maximum purchase of $5 million. And they commonly have maturities of 1 month or 4 weeks, 3 months or 13 weeks, or 6 months or 26 weeks. T-bills are issued through a competitive bidding process at a discount from par, which means they sell at less than par, which means that rather than gathering and paying interest payments like conventional bonds, the appreciation of the bond provides return to the holder. So if you buy a $1,000 T-bill, you're going to buy it for less than $1,000, but when it matures, you're going to get $1,000. And that's how you're going to be paid back on this product. Okay, so for example, let's say you buy a 13-week T-bill at $9,800. Essentially, the U.S. government writes you an IOU for $10,000 and agrees to pay you in 3 months. In this case, the T-bill pays 2.04% interest rate, right? So that's the mathematics. You see the formula right there. That's how you can figure it out. So over this 3-month period, you're going to earn 2.04%. You're going to give the government $9,800, and in 3 months, they're going to give you $10,000. It's that simple. Again, T-bills are short-term, less than 1 year. Now, the other product are T-bonds, Treasury bonds, U.S. Treasury bonds, or T-bonds. And this is a marketable fixed interest rate U.S. government debt security that mature over 10 years, more than 10 years. So you can hear 20-year, 30-year bonds. They make Treasury bonds make interest payments semi-annually, and the income that the holders receive is only taxed at the federal level, right? So you're only going to have to pay tax on this at the federal level. The states cannot tax the income that you make on a T-bond. Treasury bonds are issued at a minimum denomination of 1,000. The bonds are initially sold through an auction in which the maximum purchase amount is $5 million, and a competitive. If the bid is non-competitive or 35% of the offering, if the bid is competitive, after the auction, the bonds can be sold on a secondary market. That's the big thing here. They're sold on a secondary market. Okay, so that was bonds and T-bonds. Now we're talking about Treasury notes. This is the third type of Treasury security. So we talked about T-bills and we talked about T-bonds. Now we're going to talk about Treasury notes. Now this is a marketable U.S. government debt security with a fixed interest rate and a maturity between 1 and 10 years. Treasury notes can be bought either directly through the U.S. government or through a bank. Treasury notes are extremely popular with investors as there is a large secondary market that adds to their liquidity. So there's a secondary market where you can easily buy and sell and resell these. Interest payments on the notes are made every 6 months until maturity. The income and interest payments is non-taxable on a municipal and state level, but is taxed federally. So you're going to get paid interest from the government every 6 months. These are long-term. They're going to be up to 10 years, and you're not going to pay any federal income tax on the money you make in these. What makes notes and bonds different are the terms of maturity. Notes are issued in 2, 3, 5, and 10-year terms. Conversely, bonds are long-term investments with terms of more than 10 years. So we're talking about bonds that are more than 10 years and notes which are less than 10 years. So T-notes, less than 10 years, or U.S. Treasury notes. The next thing here, I mentioned this other U.S. government product, which are savings bonds. I think everybody sees these. At some point or another, I used to work at a place where out of my paycheck, every paycheck, the company would take money out and buy savings bonds. Savings bonds are great investments. As I said, the U.S. government savings bonds offer a fixed rate of interest over a fixed period of time. Many people find these attractive because they're not subject to state or local taxes. These bonds can be easily transferred. So you can easily give these away. You can give them out as a birthday present to your little 10-year-old nephew, or a bar mitzvah present, or whatever. They're in lots of different denominations. But I used to get them through a employment purchase at work, and I ended up with a big envelope with a lot of these. And when they mature, you can take them to the bank and you cash them in, or you can take them and cash them in and buy more. That's the smart thing to do, by the way. If you buy a bunch of $100 savings bonds, the smart thing to do is actually, when they mature, cash them in and buy more savings bonds. Because when they mature, you're not making any more money on them, right? They pay to maturity. Once they're mature, they're mature. It's not a good investment to hold on after maturity. So, very good name. It's a real retail product. It's what your average citizen was very popular for many years in the U.S. So again, let's talk again. U.S. Treasury bills, less than 1 year, short term, right? It doesn't pay any interest. It just pays you back the face value on when it settles. Treasury bonds, more than 10 years, pays interest. It's great. Dividends, right? And any money you make in this can't be taxed by the states or municipalities. Treasury notes, medium term, between 1 and 10 years. And again, any money, it pays interest. I think it's every 6 months. And any money you make on these can't be taxed by the states or municipalities. So those are the three big, I didn't include savings bonds here because when people talk about U.S. Treasuries, they're generally not talking about savings bonds. Savings bonds are the mom and pop little investments, starter investments for people. Although they're actually quite good investments for teaching a young person how to save. But for the serious investor, it's Treasury bills, T-bills, Treasury bonds, T-bonds, Treasury notes. I never hear them called T-notes, but Treasury notes. Those are the three big U.S. government securities that you're most likely to see and hear discussed. Thank you. And if you have any questions on U.S. Treasuries, govies, give me a call, send me an email, and I'll be happy to answer your questions. And then we'll move on to the next in the series,